Today's trading technique. As you know by now, this is day 3. It's Wednesday, and your host is Mundar Merji, a proud holder of the CMT designation. I am very proud to be the first in my country to be a CMT, and I am very proud that this certification gave me the chance to show the world what I know about technical analysis and why I think that this knowledge is very important to everybody who is serious about trading. Let's start. Today's subject: secondary trend breaks in the direction of the main trend, or what I call short STB. Of course, STB is a type of broker. If you don't know this by now, STB is the straight through broker, and that describes the kind of brokers who take your order and immediately execute that order in the market without taking any guesses or delays or trading against you, or so you just give them the order and they execute it immediately in the market. That's what we call an STB broker. But I know it's a play on words, but I use it to describe also the secondary trend breaks. Okay, in order to use this technique, we need to understand what is a main trend and what is a secondary trend. What do we mean by the main trend? Well, I don't want to make things difficult. I want to keep this as simple as possible. A main trend is the direction that you see on the chart, the main direction that you see on the chart. If you just open the chart and look at it and ask yourself this very simple question: what is the direction of the market? What is the direction of the market? So if the price is dropping for most of the chart, then the main trend is down. If the price is rising for most of the chart, then the trend is okay. Let's get back to the slide. First of all, let us talk about what kind of methods we can use to identify the direction of the main trend. Keep in mind that the most basic goal of technical analysis, of the entire practice of technical analysis, is to identify the trend. When you identify the trend, you know what to do. So I know a lot of people don't pay attention to this. It's very simple. It's very easy. But not all people understand it this way. A lot of people say market rising and they want to short. And that is that may be funny, but it's a human nature. They're looking for bargains. So when something falls a lot, the price of anything falls, you feel the urge to buy that thing. This is normal. This is human nature. But as a trader, you need to put stop to this. As a trader, your goal is not to look for bargain prices. Your goal is to find the trend and follow it in order to make money. Okay, so the most basic goal of technical analysis is to identify the trend. What tools do we have to identify the trend? The oldest way, and it's talked about even in Dow theory more than 100 years ago, is peak and trough. When you see tops falling down and bottoms falling down, that's a downtrend. When you see tops moving higher and bottoms also are higher than the one before, each bottom is higher than the one before it, and each top is higher than the one before it, then that is an uptrend. Okay, the second and probably the most used way of identifying a trend is trend lines. Hello, Jacob. Hello, hi, back to you. And Heather, I'm glad that you find that information useful. Hang on, stay with us for the rest of the week and you will get a lot of useful information that you will use immediately. You don't need to think about, you don't need to practice a lot. I will deliver the information that you need to know and are easy to implement immediately. Okay, so thank you for your comments. I'm trying to answer every comment and say hi to everybody. Welcome. Okay, now the third method that we use to identify the direction of the market is moving averages, and I'm sure you have seen this done on the screen by your host. I always look for weakness signs around the moving averages or strength signs. When the price is constantly moving above the moving averages, that's an indication of an uptrend, and vice versa, of course. And finally, I have a method that I really like, which is retracements. And you have seen that while we were analyzing the euro-yen just a few minutes ago. When the price bottoms, for example, at the 50% level, that's an indication of an uptrend. When the price tops at the 62% level, that's an indication of a downtrend. So if the price is moving and it stops around a retracement level, then starts moving in the other direction, this confirms the direction of the market to be, of course, the direction away from the retracement level. So if we drop to the retracement and start moving higher, that's an indication of an uptrend. If we rise to a retracement and then start moving lower, that's an indication of a downtrend. And I really hope that my time with you this week will allow me to talk about the retracement levels in details. Okay. So the most important part of this hour or this segment is how to use this technique. There are steps that are very easy to follow and extremely clear. You don't need to think about too much. You just need to know these steps and practice yourself implementing them on the charts a few times before you become able to use this very lucrative technique. Okay, step one, we identify the main trend. What main trend do we have on the charts? Using at least one of the methods that we have discussed earlier. And of course, remember that there is a concept in technical analysis which is called confirmation. And confirmation between the technical tools is very important because when we have one method that is telling us the trend is up, we have one part of the technical tools with us. But when we have two telling us that the trend is up, that is better and better. And if we have three, that is even better and better. And that is why we need to take a look when we are trying to identify the main trend, what direction the main trend is. We need to look at all of the things that we have just discussed, the methods that we talked about, and in case we have a confirmation between more than one of them, I'm very sorry about this noise coming from outside. I can do nothing about it. Street noise. So when we have confirmation between more than one method, then we have more confidence in the direction that we have picked to be the main trend direction. So step one, identify the direction of the main trend. Step two, identify a secondary trend that is moving in the opposite direction. Of course, secondary trends mean trends that usually, or not usually, that always move in a direction against the main trend. So if I look at the chart, I see most of the chart is going down, then just a little part of it is moving higher. This is the secondary trend I'm talking about. I want you to focus on the small part that is moving higher against what you see all over the chart. Okay, number three, wait for the secondary trend to give signs of reversal. So now I now have a main trend. Let's say the main trend is up. I have a secondary trend. In this case, of course, when the main trend is up, the secondary trend is down. That's a must. There's no other way. And Now I need to see that this small part of the chart that is falling down, I need to see signs of reversal on this part. So if the trend is up, the secondary trend is down, now I need to look for any signs that the price is going higher again. For example, and one of the most used and the number one sign that is used in this technique is breaking of a trend line. If we see this, we move, of course, to step number 4, initiate a position in the direction of the main trend. The direction of the main trend in this example is up, so once a trend line that is bordering the secondary trend is broken, to the upside, we initiate a position in this direction, and that means a buy position, a long position. Okay? The target, finally, you have to keep in mind, of course, by now we have implemented the technique, but you still have to wait for the target. The target for this position should be a new trend high. So, a new trend high in our example, where the main trend is up. If the main trend is down, of course, the target for this position should be a new trend low. Yeah, Heather, the reversal, of course, it is delicate, and that's why we have tools to help us decide. One of the greatest things that you can do to yourself to deal with delicate concepts is to cut the guessing to a minimum. So you don't have to guess, oh, let me take a look at the chart and let me guess if this thing is moving up and down. I don't need to do this. You don't need to do this if you use the right tools. With the right tools, you can minimize the guessing. The right tools, of course, for talking about a reversal or trying to spot a reversal, in my own opinion, include trend lines and moving averages. And I have been using these on the charts for the past few days. I hope that you have caught the right way to use these techniques, and you will start to use it soon. So when the secondary trend is falling, I look and see if there's a trend line that I can draw above the falling secondary trend, or if there are moving averages, especially my own favorite, the 35 and the 49, that can tell me anything about this trend. Still weak, still going down, or the price is getting above the moving averages, in which case it means that it may be time for the main trend to resume. And this is probably the best time to get in the market, or one of the best times to get in the market. You know, market timing is everything. Market timing, I'm trying to remember this quote by George Soros. I don't memorize it completely, but the concept is this: if you are right and you get in too early, then you are wrong. If you are right about the market and you get in too early, then you are wrong. You may say to yourself, what is this guy talking about? I want to buy, and the market eventually moved higher, so why am I wrong? Well, for two reasons. If you get early, then the price will move lower, and that means that you will be missing on some of the profit, and this is reason one. But another reason that is more important than missing on some profit, of course, there is some waste in every position, so you can't expect to harvest all the profit that the market gives you, of course not. So it's okay to miss on some profit, but what about the stop? What about the stop? This is the second reason. If I get in early, let's say I expect the euro to go up, but I bought at 112 and the price dropped to 110.50, and then it went up to 115. So if I hold on to my position from 112 to 115, I'm making amazing profit. But what about the time when the price dropped to 10.50? Will I be able to hold on to my position with that kind of loss? Where is my stop? Did it hit? So all these questions, you may be out of the market before the move higher that you were expecting. And in this case, what good is your position? You have lost money, although you have expected the right move in the market. So market timing is very important. It separates the winners from the losers, the good trades from the bad trades. Always try to get in the market at the right time. And one of the best techniques that give us the right market timing is this technique, in my own opinion. I think getting in when the secondary trend reverses is one of the best times to get in the market. So with that, we have completed talking about this technique, and now let us move to this example. I have prepared one example in details for you, and it's a recent example. Of course, you know by now I don't use old examples. I always try to find something on the charts that is recent, so you guys can go back to the charts and look at it and practice yourself and follow up on the technique with recent market information.